All right. So for our viewers' background, if you get a loan for a building that already exists, then that building and its income stream, the revenue that it's generating, can be the collateral for a loan. So when you guys are underwriting it, you can say, well, worst comes to worst, we got the income from that building if it's performing well. So in theory, you don't need recourse to anybody's personal assets, although I'm sure that still comes into play sometimes. But it doesn't work for construction loans because if you're 6 months into the project and there's a huge hole in downtown Chicago, there's really nothing for you to repossess other than just the land, but you may be out a significant amount of expenses, and that's where I know that lenders generally require for construction personal guarantees. So if you were going to define for a layman what a personal guarantee is, how would you unpack that idea?
Sure. Well, I mean, from a high level, it's exactly what it sounds like. So this individual or, whoever the guarantor is, corporate entity, is guaranteeing repayment of the sum of money that has been dispersed. So when you kind of dig into the language of a guarantee, it talks about repayment, it talks about performance, it talks about repayment of, the original sum plus any costs of collection. So basically just, it's kind of a make whole to say, I'm guaranteeing that when, if things fall apart, I, as the personal guarantor, will have assets available or will make assets available to make whole the bank.
And just for kind of illustration purposes, I mean, what's the process that goes on if and when you guys make a loan to someone and they do go belly up and they're not able to pay? Like, what is the legal process when you go to collect?
Yeah. So from a legal standpoint, initially there would be, like a foreclosure typically would be the first step in that process. And then along with a foreclosure, to collect on the personal guarantee, the personal guarantor themselves would actually be sued individually. So, so
it's kind of a probate thing. It's not like you can just immediately seize their assets in some sense. You still there's a litigation process.
Oh yeah. Yep. It goes through the same litigation. So it's part of the litigation process of the overall foreclosure of the project, or, if there's a bankruptcy involved or something. And part of the reason that personal guarantees are important is in the event of a bankruptcy, if the entity itself is bankrupt and the debts are discharged, there's no other recourse. If there's a personal guarantee, the bank can still go to that personal guarantor, and receive, by suing them, receive a money judgment. So it would be similar to a business entity. We'd have a money judgment for that person to say, the judge in that case would award, okay, you have a money judgment of this dollar amount owed to this creditor, and basically are prevented from selling or collecting sums from other sources until that debt is repaid.
Not a fun process. So as we start thinking about it, I have a lot of questions about the exact process and some of the rationale. But let me start with the rationale, kind of both legally and economically. So in one respect, whenever a developer is coming to get a loan, in some sense, it's a business transaction. You guys, obviously, your business is the lending of the money and the different, fees involved and placing that capital well. And so it can be difficult sometimes for a developer to know at what point is the business part of the negotiation ending and then suddenly FDIC/SEC kind of regulatory frameworks which you are subject to start entering in. So that's always been a curiosity for me. For personal guarantees, do the FDIC and or SEC mandate certain personal guarantee practices for construction loans that you make?
Yeah, so one thing that's good to kind of separate first is who your regulator is. So different banks are regulated by different institutions. A nationally chartered bank would be regulated by the OCC, the Office of the Comptroller of Currency. A state chartered bank would be regulated by the state's own, kind of like in Wisconsin, our DFI, and then additionally would have some sort of since most state banks are subject to FDIC insurance or are insured by the FDIC, they'd also have some oversight by the FDIC. But one thing I guess I like to get out there right away is when we talk about the regulators, it's a pretty broad term that can mean a lot of different organizations depending on what kind of bank you're dealing with. So for us, from our, as I work for a nationally chartered bank, and in that case, the OCC basically, there aren't from a hard and fast rules standpoint. They mostly are. They don't deal in hard and fast rules. They deal in risk mitigation, basically. And
developers
safe and
can
sound
appreciate
lending
not having hard and
practices.
fast rules on regulations. We can appreciate that. So,
Sure. So from from kind of a risk mitigation standpoint, number one, the OCC is looking, or the regulators are looking, to make sure that you have a loan policy, first of all, and a loan policy that seems, reasonably structured to protect the interest of the bank and the depositors of the bank. And then B, most importantly, that you're following your own policy. So they want to be looking to see, okay, are you actually following the rules that you've made for yourself?
Right.
And if
Well,
not,
fair.
if you have exceptions to that, why and how are those mitigated?
Okay. Well, that makes sense. I have never even heard of the OCC. That sounds scary. So before we move on to talking about those other things, so if that's the regulatory side, let's talk about the economics. And I know we may look at the economics of this differently, since we have, different developers trying to maximize the upside, lender in some sense is trying to minimize the downside, because there can be so much downside because you have such a strong stake in the project. So for our viewers, just a little background, and as how my thinking has developed on it, because guarantees are a crucial part of understanding the development world. So all real estate projects throughout all of history have required capital of some kind. It's a very capital intensive thing to do, but they haven't all been capitalistic in the modern sense. And as you and I have discussed, my understanding of capitalism is that you can have this division where one person has the capital and the other person has the good idea, and that's okay. And we can find an economic arrangement. So if I go to Silicon Valley with an app and I say, well, I think this will work, and they say, okay, we'll give you $5 million and we want 30% ownership of your idea, we can find an arrangement whereby it works. And if we come back specifically to real estate, as I've kind of thought theoretically about personal guarantees, it has seemed to me that they, in some sense, are a rejection of this division between the person who has the idea and the person who has the capital, and that they force the person who has the idea also to have the capital, which is to say, to be a very wealthy person, generally speaking. And that maybe that also explains some of development's culture, because if developers must be very wealthy people, and we all know what very wealthy people are like, does that not explain some of the culture that one finds in it? And so I've always been interested, would there ever be an economic rationale for a bank to take a much lower LTV on a non-recourse construction loan, so no personal guarantee, or to do a construction loan at a normal LTV but with a significantly higher spread, for a very good project? Obviously couldn't be your bread and butter due to its risk profile, but it could be a point of diversification if you had a tenant, or not a tenant, but a developer, a client who you thought was your prime rate kind of tenant. So I'm just curious on that, because obviously for developers, and especially for startups, this idea that you have to have the good idea and also be able to guarantee it with your own personal fortune is kind of a non-starter, obviously, for a lot of developers. So how do lenders think about what I'm suggesting as this great conflation of capitalism?
Sure. So there's a lot in that. So I'm going to maybe look at a couple of different pieces of that. Let's start with kind of this idea of the person with the good idea and the person with the capital. And so your analogy of a venture capitalist, for example. So somebody has a great idea for an app and they say, okay, I believe in your idea, so I'm going to put $5 million and now own 30% of your company.
Right.
So in that situation, actually the person with the idea and the person with the money are then kind of in one organization again, right? They're one company. Yep. And they kind of fall under a certain umbrella by virtue of the 30% ownership of the VC. So we would look at it similarly as a bank. Our own policy, and I think a common policy is anybody over a certain level of ownership, we would be looking to provide a personal guarantee on a loan. So in that case, it's kind of a similar arrangement with the VC thing, where as a 30% owner, they're now kind of part of the company and part of the deal and part of the idea. And in this case, if you have to your question about if you have a great idea for a development,
right.
It's just really a matter of getting somebody to buy in. So if you have somebody
Right.
that has a guarantee that can provide a personal guarantee as a risk mitigant for the bank, if they're willing to invest, up to 20% of your project, then you do have a guarantor that you could rely on
Right.
to get a project done. And then the second piece of that, in terms of an economic arrangement, is a good question and an interesting concept. And as I started to think about that, though, from an economic perspective, it would become somewhat difficult, I would think, from the investor side, because as you reduce your loan to value, as you reduce the bank's exposure, so as you
If you went the
reduce a
low
loan-to-value
LTV
ratio-
route, you're saying.
What's that?
If you went the low LTV route, you're saying.
Right. As an example, the low LTV route. So then you have more capital in to make
Sure.
up that project cost, right?
Sure.
The differential between the loan and the project cost.
Yep.
And at that point, then the returns to the investor become so low that what is their incentive for putting in equity capital that's, inherently riskier capital when they're really getting the same return as the bank?
Yeah, I mean, it depends on how you structure it and, of course, how long it's out there. Well, so for our viewers' background, one thing that's helpful is that I think a lot of people know in development you have to go out and get investors. But, of course, most of those investors, and that might be a good transition, most of those investors aren't signing a personal guarantee. If it's passive investors, if I need to raise $5 million and I raise them in $100,000 increments, you're not getting 50 people's tax returns and 50 personal guarantees. And so in some sense, what you're suggesting, which is also, it can be very innovative, is if there's the developer, passive investors, and then separately, or maybe one of those investors is a guarantor. So you have three different parties, right? Very often it's the developer who's also the guarantor and passive investors. But you're right, it is possible to split it into three different parties if the developer themselves can. So do you see a lot of third-party guarantors? I'm sure you see multiple guarantors, and so maybe the developer guarantees it and then their construction partner guarantees it, or who knows how they work it. But do you see often where the developer is just the idea person and then they're getting passive investors on the one side and a true third-party guarantor who would get a guarantor fee as a third party? Does that come up much?
I think I see what you're asking. So from the standpoint of a true third party, a complete unrelated,
and maybe there is an investor, but it's not the developer
so
guaranteeing it; it's an outsider.
Right, and that's kind of what I was going to say. Is an outsider certainly you wouldn't see that, because not only would it be they wouldn't have a lot of incentive, that outsider wouldn't have a lot of incentive to provide that guarantee, but also then you'd run into probably legal consideration issues from a legal perspective. What consideration do they have to provide a guarantee in this project in the first place, and is it even a legally valid agreement to make?
Oh, I see. I see. So, it's kind of like with certain purchase agreements. If you say this is contingent upon us getting reasonable financing, and you don't specify what that is, the court can say that was not a conscionable contingency, because who decides what's reasonable? You do. And so you're saying that if they don't have enough stake, if you went to collect on the guarantee, they could say, actually, I wasn't even involved in this project. I just signed that. You can't possibly think you're going to come after all my assets for this.
Yeah, and I think I don't remember what the language is in the guarantee form, but in the actual documentation for a personal guarantee, it typically says something along the lines of "in consideration of," and then, for example, the returns that the guarantor will get from the project, or the equity that they're putting into the project, but basically something that says we're acknowledging that you have ties to this project, which is consideration for providing a guarantee on this project. So to go back to your question, it would be unusual to see a complete third party who is kind of a guarantor for hire, so to speak. But then
There's so
from
few
the
and far between guarantors for hire.
there, maybe that's a business model for you. You can figure out the consideration thing. But then from the standpoint of, kind of a passive investor, I think that is something that you see from time to time where maybe there's kind of like a lead investor of the group that is strong and that provides a guarantee. I would say that it's not often that I don't see somebody from the development side also though providing a guarantee. So it would be unusual to have only a lead investor, passive investor, and no what I would call maybe the sponsor of the project, no involvement from the sponsor of the project. And often that's because the sponsor would retain at least a 20 to 20% ownership in the end project. So from our policy standpoint, it kind of ties back to anybody that has 20% or greater ownership in the entity, we would be looking for a personal guarantee from.
Right. That
now,
makes sense.
also, I think it's important, and maybe this isn't the right time to bring this up, so we can circle back to this if you want to later, but I think it's important to kind of clarify here what the purpose of or not necessarily the purpose, but there's the guarantee from the perspective of, does this person have a strong enough balance sheet to fix a problem, right? But there's also just the guarantee of, okay, so maybe a developer doesn't have a strong enough balance sheet to fix a problem. But we would also, I think it's sound risk mitigation to know that developer is invested enough in the project, is adequately invested in the project to make sure
your
that
interests
they will
are aligned.
help solve problems if they occur.
So another question, once you say, all right, we're perhaps interested in this deal, is when, as you're kind of more globally underwriting the deal and its economics, when you would ask, and also when developers are usually comfortable giving you the information to further do their own personal guarantee underwriting, because you're basically showing someone every single thing about you financially. Sure. And I know a lot of people they don't hand that out the first meeting, right? Hey, here's my card, here's my, full balance sheet. When do you usually see someone handing over all of that information in the course of underwriting a project?
Yeah, that's a good question, because it does become a little bit of a chicken or an egg thing, right? Where
you don't want to proceed until you know the guarantor is there, but they don't just want to email this to everyone.
Yeah, and that's where, again, having a relationship, an existing relationship can be really helpful when you're working with,
you're just getting an update
with the bank,
basically, because you've already taken a look at it. And
sure, you kind of know who the sponsor is and you know who the typical guarantors are. But in the case of building a new relationship, I would say, the first thing we would work with is a package of information about the project itself. So the cost budget, the projected rents, some rent comparables, maybe a market study. So kind of understanding our expectation of the overall cash flows expected to be generated from the project, and then the cost to construct that, and what the equity, what the capital stack looks like, what the equity coming in is, and assuming all of that is kind of normal and looks good, then maybe it would just be a lot of times we have just kind of a conversation with those to say, who do you anticipate the guarantors being? Who would be guaranteeing the loan, and give us kind of a ballpark of what they look like financially. Are we, ballpark liquidity, ballpark net worth, just to kind of give a sense. And then typically a term sheet or a commitment letter would have some kind of language about being subject to full underwriting. And, typically we want to just vet out and make sure early in the process that, we don't anticipate there being any really big surprises here.
Another question.
Yeah, go ahead.
Another question that it's not specific to guarantees, but just since I'm talking to somebody who knows this world, developers, or at least when I hear it's going to loan committee, I have no idea quite just the mental image. So are those usually calls? Is it a room with 50 people? Is it 5 people? How many people, say, at your community regional bank are in a loan committee meeting? How long is the meeting? How many projects do you underwrite in such a meeting? Or how long do you spend? If you were going to pitch a deal, I showed you how long is the presentation. I just have no concept for that. It should be interesting to hear.
Sure. Yeah. No, and that's a good question. That's kind of what I was thinking about is, I would say from a process standpoint, first, it's we do something like a pre-flight, kind of a pre-flight committee that it's the same committee, but we'll say, okay, here's our high level deal. Maybe before we issue a term sheet, we'll say, okay, credit folks, here's kind of where we're looking at this deal. Here are some of the metrics. Here are some of the expectations we have. Here's maybe a high level idea that we have of who the guarantors are and what that'll look like, and kind of get feedback from there to start with, so that before we issue a term sheet, we can make sure that, everybody's on the same page. We all feel good about this. Then we can get a term sheet out there and say, okay, here's our, and that gives the developer, I think, then some comfort to say, okay, now I know what I'm working with, and now I'll feel more comfortable providing some of that personal financial information when I know what our deal is going to look like and whether it's something that we want to go forward on. So after that kind of initial pre-flight, we take a lot of that same information on the deal. We talk about, first of all, I guess we put together a paper file, a paper presentation that explains what the project is, who the sponsors are, where it is, what the pro forma rents are, what the market is like, kind of all of the background information, all the economics of the deal. And that's usually distributed 3 to 4 days before our actual committee takes place, to give people some time to learn the deal, understand kind of what the questions might be, or what some of the
And then each deal is in the same template, I presume then. I mean, I've seen some loan presentations that have been put together. So every time you're looking at it, regardless of how it was submitted to you, you're evaluating it in the same template.
Yep. So they can see quickly and easily, okay, here's what the debt service coverage is going to look like. Here's what our underwritten expenses are. And it's kind of a similar and familiar template. So to your question about how long is it, how many people, from a how many people standpoint, for us, typically most banks would have an actual committee. It would be made up of some credit staff, the relationship manager that's bringing the deal in would be presenting it, and sometimes is also a member. For us, we have different members of the sales staff that rotate through our credit committee. So on a quarterly basis, you may have different people, but they all represent people from different parts of our market, and on both the sales and the credit side. So for us, it's a 5-person committee. It's a voting committee, and typically, so potentially you could have, a 4-to-1 vote or something. But for the most part, it's usually pretty consistent that there's a consensus building. And then how long it takes it depends on the deal. So sometimes you have really easy, straightforward ones that it's like, okay, every box is checked. Yeah, this is an easy deal. Yep, looks good. Maybe it takes 15 minutes. We've had conversations with it beforehand, so it's really kind of just a formalization of the conversations we've already had. Sometimes deals are really tricky, and there's a lot of questions to walk through, and a lot of so I would say, maybe there's a 5-minute period at the very beginning where 5 to 10 minute period where we'll walk through the deal. We'll give kind of an overview, but for the most part, people know what the deal is to begin with. So it's mostly a lot of question asking. And then that's an opportunity for people to say, hey, I see your rents are projected at 15% above market. Walk us through why we think that's going to happen, as an example.
Yep. Gotcha. And I know that some of them, this is probably taking us even further afield of guarantees, but I know that some of the ones, or maybe all of them that I've seen, have a risk, the different folks assign their risk level to it. Is there an industry standard credit underwriting risk system that's used, or does every bank have its own proprietary risk rating system?
Typically, each bank will have their own risk system, but they're usually kind of based around a lot of the same metrics. So it'll be your risk rating is kind of made up of what the leverage is, what the cash flow is, who the sponsors are, kind of the overall credit things that we're looking at from the beginning.
Right. So once you say the deal pencils to us, developer, here's your term sheet, send us your balance sheet stuff. I know it's not just your balance sheet. Obviously, there's tax returns, there's a personal financial statement. So maybe walk us through what if let's say this is a very tricky deal and you say, we're going to need everything to underwrite this one. Everything means, and here are all the things that you're going to request. I just ask because I've occasionally heard of schedule this and form that and
Mhm.
not had any idea what that was. Maybe unpack the kind of things that you would expect to see if you were getting just a massive guarantor pack with every conceivable document in it.
Yeah, well, and for us, it's usually the same information that we would request every time. So, by the end
Okay.
of the process, if we're looking for like a full approval, the information that we want to have on file for each guarantor would be a personal financial statement, so a current personal financial statement that lists all the assets and liabilities of that guarantor, and then 3 years tax returns and
Mm-hmm.
the tax returns, so 3 years complete tax returns, and that's where it can sometimes be, I think, confusing because we would want to get a full. Sometimes people will send like the first 2 pages that show their AGI,
Yep.
but the tax return is really valuable for us because it gives us an idea of what other investments and projects that guarantor is liable for, essentially.
Right.
So, you mentioned some of the different schedules. So Schedule E, for example, will list out all of the pass-through income
Uh-huh.
that an individual has.
Mm-hmm.
So the pass-through, so, sometimes we'll get the Schedule E, but it only has 4 lines on the original form. So then you need to have all of the statements that show,
Uh-huh.
everything that rolls up onto there. So it'll have 3 lines and then it'll say statement 32 for additional information. So you need to make sure you have all of those statements to
Supporting,
show all of the
yeah.
entities that are rolling up.
And
So
is,
the reason that we need all of this information is it is really valuable for us to see, maybe you think, oh, okay, great, this guarantor has $1 million of liquidity, and that's really helpful for us. But then you get a tax return and you realize, oh, but also they have 4 other projects under construction right now, or they have all of these other investments. So basically they have a lot of demands on their liquidity, and we're looking to see what's your overall global picture, because it's not just our project that can go wrong. We recognize that a lot of people are involved in a lot of different projects, and so we want to make sure that we're thinking everything is going along really smoothly here, but we didn't know that maybe this guarantor is invested in something else on the side that could be really risky, that we would want to take into consideration with
right.
our project.
What is a contingent liability schedule? I understand kind of what the concept is, but maybe for our viewers, explain what that is. And because I think it's a more formalized calculation of what you were just saying. Is that a part of one of those things, or do you use those documents to create a contingent liability schedule?
And yeah, so maybe I guess that to go back to some of the financial information stuff, a personal financial statement will have the assets and liabilities, but often we would ask for a global cash flow statement as part of that. So there's not necessarily one standard form, but I think there are some common ones floating around out there that have columns with a lot of different information about each of the projects that a person might be invested in, including the NOI of the project, but then the debt against the project and the percentage guarantee. So that kind of helps understand, because for stabilized projects, for construction projects, typically you're going to be getting a complete 100% guarantee, because there's no, like you said, there's no underlying asset that's complete
Right.
at the time of the project. But it's not unusual to see, there may be burn downs upon stabilization of a project where your guarantee goes from 100% to 50%, for example, on a stabilized project. So that global cash flow kind of helps line out what a person's individual liability
Across
via
all the
guarantee
projects of which they're a
is.
part. Yep.
Yep.
Well, and another thing that I haven't thought to ask, but which is very interesting, is just the question: are there standard metrics? And I know you have balance sheet assets, kind of broadly speaking, but my understanding is that you guys are as or more interested in liquidity, because that's what you can actually, maybe I can't pull out some of that, it's an asset in theory, but it's in no way easily liquid.
Right.
Are there multiples which are standard, like the guarantor for this, if it's going to be a single guarantor, ought to have total assets in a multiple of X of the loan we're making, and liquidity in a multiple of 1 year's P&I? Like, are there metrics like that you look at?
We don't have metrics like that, and partly because of the complexity of the overall situation, right? So, like we said, a lot of times our project isn't in isolation. The developer has multiple projects.
I
They have
see.
multiple other investments. They may even have other projects going at the same time. And so, we don't want to set up so many policies and requirements and metrics that we aren't able to be flexible and kind of take each case as it comes. So, if a guarantor has X amount to to 3 different projects, we're gonna make some consideration to say, okay, but this one is going to be completed in 2 months and is looking like it's on schedule. This one is further out, and we don't want to give yourself too much rope to hang yourself with, right? So we don't want to set up so many metrics that we aren't able to find ways to make deals work with really strong sponsors.
Now I've got some. I don't do this very often, but I have kind of questions from our viewers. They haven't seen this, but I've asked a few developer friends what questions they would ask about personal guarantees. So they often want to talk about the idea of why do you need an unlimited guarantee versus if I can guarantee the amount that this project will be for, if I am so extremely fortunate as to have a huge spread between what this project costs and what my balance sheet has in it, why do you need this unlimited guarantee?
Sure, yeah. So unlimited, basically the unlimited language helps us get to, there are a lot of costs, I guess, to a collection scenario outside of just what the loan amount is, right? So there are attorney's fees, there's litigation costs, and the unlimited kind of catch-all helps ensure that, okay, maybe your loan is for $1 million, for example, but by the time everything is said and done with all of the additional, or it could be additional costs to complete a project. So for construction in particular, maybe the project kind of, and 2005, 2006 would be a good case study where a lot of projects just sat there for a really long time. And so there were a lot of additional costs that ended up going into it, holding costs that maybe ended up going into it, or construction costs increased during the process, and so the cost to actually get a saleable asset to foreclose on even could be higher than what that original loan amount was. So the unlimited language kind of just helps protect the bank to say, in construction, a lot of things can happen, and it's we don't have necessarily a set dollar amount that gets a stabilized project. So that unlimited language helps kind of protect against, hey, we just need to be made whole.
So my viewers said they expected you would say something like that, and they said, okay, well, when there's multiple guarantors, why do they all have to be unlimited? Because surely if we have multiple guarantors who are each covering the full amount of the project, usually you still want them all to give unlimited personal guarantees, right? So, I mean, is that at some point, there's this balance, and this is where I go back at the beginning to it's a certain business negotiation, right? Because obviously there's guidelines and so on, but on the other hand, like it's asking a lot for all of these people to have unlimited guarantees. So is there a point at which you say, okay, we're guaranteed enough? Or I mean, is pushing for as many kind of unlimited, obviously it's the gold standard, and you're trying to get what you want out of the transaction to make it as safe for you as possible.
Yeah, and I think it is important to kind of frame this in that we are talking about construction lending, right? And so because so much can happen and there are so many unknowns in construction, I think that's where you see banks really wanting to make sure that they are getting all of their bases covered from a guarantor perspective. So from the unlimited standpoint, yes, you might have multiples, but also just because somebody is providing a guarantee doesn't mean that they're actually going to, on the day that everything goes south, probably a lot of people are there. Probably people's balance sheets look a little bit different at the point that you're actually starting to look at collecting on a busted project, right? So the unlimited guarantees for multiple guarantors just gives us more options to say, okay, we had 3 guarantors on this deal, and as it turns out, 2 of them now, are in a rebuilding time and don't have the assets that we originally.
That's a nice way to put it.
Yeah,
rebuilding time.
Don't have the assets that we originally underwrote the deal to. So then, when you have only one of the 3 left, then it's good to know that you aren't going to be able to collect only 1/3 of the loan. You can still try to be made whole as much as possible from any of the 3.
Sure. So,
So I guess developers also probably want to pick their partners pretty carefully.
that's correct. Which they're so good at doing, as you know. Um, so my understanding is that once a project reaches a certain size, though, and we've discussed this a little bit, I know maybe outside of your wheelhouse as a regional community lender, but we can just speculate a little bit about it. Walk us through, kind of what you would expect to happen if a project, had to be guaranteed, and this is, let's say it's a quarter billion dollar, $250 million urban master plan redevelopment of the whole downtown kind of thing, what you would expect to see in terms of guarantee structures.
Yeah. Well, so, and I'm glad you brought up the corporate guarantees because that's a good point. And if I could just backtrack for a second on that.
Of course.
A person, I guess when I'm talking about personal guarantees, like you said, it is kind of a sponsor guarantee. So sometimes that personal guarantee, even in a deal for a regional bank in a $5 to $50 million deal, we may be asking for corporate guarantees depending on how that borrower's financial picture is structured.
Mm-hmm.
So if the actual owner of the entity, of the single asset entity that will be holding a project that we're lending to is a corporate entity, then maybe we would be asking for the guarantee of both that corporate entity and then the person who owns it. So basically just making sure that, that where the cash and where the financial resources flow to
mm-hmm.
are all equally kind of committed to the deal. So going back to your question about a really big project, yes, to speculate on how the big boys do it, I think at that point, you probably get a little bit more, they may be funds at that point that are constructing things, or you may get a little bit more dispersion of ownership where there's not necessarily one, person who owns 50% of the company that's doing all of this. So a corporate guarantee in that case would be, maybe like maybe a management company. So sometimes if there's consistent cash flow coming from a management company that
mm-hmm.
does all these, basically just a source of capital and cash flow that could be looked to mitigate the risk of the deal falling apart, and could be looked to provide support and fix a problem if issues do happen.
Well, and presumably also maybe a few different, does Wells Fargo participate on these things? I just wonder, as these deals get so big,
mm-hmm.
Lending $300-400 million, I suppose that's just speculation, but I just wonder whether they, on deals like that where it looks like, okay, the senior lender has a $200 million position, I just wonder whether they do, or whether it's been participated out. They're the lead and they have 4 people at 25 or something. It's just a lot. It's a lot of exposure.
Maybe, or even if they are holding the whole thing, also when they're doing maybe $200 billion of financing a year, that project is still relatively small in relation to all of the dollars that are going out the door. So in terms of a diversification, I think banks, I would presume, banks of any size are or should be or would be looking for diversification of risk, right? So you just want to make sure, and that's why you see hold limits sometimes. So
mm-hmm.
I don't, those hold limits probably grow the bigger bank gets, but concentration limits are something that, going back to the regulators, concentration limits are something that the regulators look at
mm-hmm.
to know that you are not overexposed to any one part of the market that could cause
mm-hmm.
a big, if that part of the market were to go flat, that would cause a big issue for the bank. So it can be by borrower, it can be by developer, it can be by asset class, multifamily, retail, by tenant type. So I think, for those really big deals, they may have enough diversification that the risk profile isn't quite as elevated.
Mm-hmm. A last question, and this also may be just speculation unless anyone's written a history of personal guarantees, but to what extent, so as a development cycle progresses, developers often have less good deals to look at, which probably then trickles down to you, and maybe you guys have fewer good deals to loan on, and whether it was with SNL or the CMBS thing. Obviously, the expansion of the credit markets necessarily to stay in business and keep lending loans is part and parcel of the whole idea of the development cycle, right? I mean, it has to be funded somehow. So I'm curious, obviously, in the residential markets, looking at the underwriting that banks do or don't do, most importantly, for subprime lenders and so on, has been kind of a benchmark for where we are in the cycle and all that kind of stuff, which is just to say that even at multi-billion-dollar institutions, things change in response to the need to keep a certain deal flow going. With that in mind, if FICO score is kind of the proxy that maybe a residential mortgage lender uses to determine whether you're going to make a $300,000 loan to someone or a $250 for their home, do you find standards change over the course of a development cycle regarding personal guarantees? I mean, it's kind of the proxy, right? 300,000, 30 million, credit, approval rating, have you anecdotally heard that underwriting of personal guarantors has play in it during the course, for better or for worse, during the course of a cycle?
That's a good question, and certainly during the course of a cycle, I think you will see competition among players in the industry. So, that can come in the form of certainly of rate and spread, of some of the structural items. So, maybe like appraisal leverage versus cash flow leverage. There may be different metrics that banks are trying to hit there. I personally haven't seen guarantees be as susceptible to that, and I think some of that is just because it is kind of a lot of times it's kind of a policy driven thing where it's for a construction loan, I think you're always going to be looking to some kind of guarantee. I think there probably that negotiation probably can get a little bit a little feistier during when you're starting to see less deals, when deals are getting harder to put together and banks are still trying to make some deals work. Maybe then your question about some unlimited guarantees from 3 people versus limited to 150% of their individual ownership shares. There could be some stuff like that.
From unlimited to 150%. There you go. That's progress.
There you go.